I trust you're all safe and well. My name is Paul Sokolowski. I'm a partner at Arnold Block Leibler and the leader of our taxation practice. We are very happy to be presenting the second webinar in our webinar series, Quick Takes on Tax. Welcome to our overseas guests and all of you situated in many parts of Australia. We pay our respects to the traditional owners of this land and their leaders, past, current and future, with whom we can walk together in a movement of the Australian people for a better future. Before I introduce our speakers, some further housekeeping. Your video, audio and chat function will not be enabled during this session. You will not be visible to anyone else on the webinar. We will address questions at the end, and if you have any questions, please use the Q&A button at the bottom of your screen to type in questions during the course of the presentation, and we'll get to as many questions as time permits. Now to the topic of the day. In a glacial pace of change we can now scarcely imagine, March 1979 saw the first major changes to Division 6 of Part 3 of the 1936 Act since its introduction before World War II. So over 41 years ago, Parliament brought in changes to Section 99A, along with the introduction of Sections 100A and 99B, the emergence of the capital A's and B's. With Section 99B, we saw Division 6's somewhat belated engagement with the real world of trusts and international tax planning. It sought to deal with the gap in taxing distributions to Australian residents of accumulated foreign income, but it was not until 10 years later, in 1989, that we eventually saw the logical companion piece to Section 99B, measures designed to deal with the accumulation of offshore trust income in something closer to real time. Division 6 AAA, containing the transfer of trust rules, was born. To take us through these provisions, I have great pleasure in introducing our presenters today. In order, my partner, Jonathan Ortner, who will deal with the transfer of trust rules, and Peter Scott, our Senior Associate in our tax team, who will deal with Section 99B. Jonathan and Peter, let's have a conversation about the transfer of trust issues and Section 99B. Jonathan.
Thanks very much, Paul, for the introduction, and thank you everyone for attending the second of our 4 webinar sessions. So today's presentation considers 2 specific integrity measures aimed at foreign trusts. The first one in front of you, Section 99B, as Paul said, deals with the taxation of distributions received by resident beneficiaries, and Peter will talk to that a bit later on. And the transfer of trust rules under Division 6 AAA contemplate the taxation of what is called the transferor in respect of accumulated but undistributed income of a foreign trust estate. So just a bit of an introduction into these provisions. We're often asked by foreign advisors and clients about the tax treatment of distributions from foreign trust estates to resident beneficiaries. And that's often the case because of the significant wealth that individuals have accumulated during the period that they have not lived in Australia. And if they're looking to commence residency here, they want to make sure that that income, that capital that they've been able to generate whilst living overseas is protected from further taxation in Australia. But an often overlooked provision is our transfer of trust rules. And we frequently need to remind advisors that their client may still be subject to tax even where they haven't received a distribution from a foreign trust. And it could crystallise an unfunded tax liability given no cash will be received by the transferor. The journey that one must go through to actually find out that these provisions really only apply to non-resident trust estates is a relatively tortuous one, but that is in fact the case. So we are only dealing with foreign trusts when we're talking about these rules. And the other point to note is that the CFC regime, so controlled foreign company rules, and the transfer of trust rules, both are looking to achieve a similar objective in that they're trying to prevent the ability of taxpayers, resident taxpayers, from being able to roll up and accumulate income offshore and defer Australian tax until that income is ultimately repatriated to Australia, or in some cases avoided altogether if it's never returned. The transfer of trust rules are, however, broader than the CFC regime in that included in the attributable income, which is a concept that we will come to, is more than just passive income, which is all that will be included for CFC purposes. Active income is caught as well. And the other part of this is that in terms of how a transferor may be assessed, it does not matter about the value that they have transferred to the trust. In other words, it doesn't drive off an attribution interest like the CFC rules does. They are simply taxed. The transferor is simply taxed on 100% of the accumulated income. And there are some caveats to that, which I'll come to a little bit later on. But in taxing the transferor, the provisions really adopt a second best policy solution by seeking to tax the person who transferred value to the trust rather than the beneficiaries or the trustee or the settler of that trust. The assumption being that whoever transferred value to the trust must be able to benefit from it somehow. And so it makes sense to tax that person rather than waiting for the beneficiary who may or may never receive a distribution from the trust. Remarkably, there's not been one single judicial decision dealing with the material provisions, but the lack of judicial authority should not give advisors any sense of comfort that the Commissioner does not apply the provision in practice. We're frequently engaged with the ATO on the issue, both in the context of tax disputes and voluntary disclosures. So we'll turn now to what is the first critical ingredient for these rules to apply. So that is, we must first find, on the assumption that we have a foreign trust estate, we must first find an attributable taxpayer. And what you can see in front of you is 6 key requirements. And I view the first 3 really as being the gateway conditions that must be satisfied in order for a taxpayer to be an attributable taxpayer. The bottom 3 I refer to as basically a backdoor out of the provisions. They're exclusions. So if you're able to fall within any one of those 3, then the taxpayer will no longer be an attributable taxpayer. The first requirement is around whether the trust is a discretionary trust. And this is a defined term, as most terms are in the transfer of trust rules. They've got their own interpretation section, so it's important to bear that in mind. And basically, a discretionary trust in this context is defined as being anything that is not fixed. So the width of the definition is really likely to have the effect that many trusts which are not ordinarily considered to be discretionary trusts will be for the purposes of these provisions. The other requirement being that it's not a public unit trust. More often than not, in the kinds of circumstances where we're advising clients or advisors, the answer to that will be no. A public unit trust is or takes its meaning under Division 6C. And so if you're dealing with a closely held family group and your typical sort of offshore family discretionary trust, then that will be a pretty straightforward question to answer. But one of the more fundamental requirements of these provisions is that the taxpayer has transferred property or services to the foreign trust. And that's where obviously the transfer of trust rules gets its name. The provision covers actual transfers and deemed transfers, and it's not just limited to acts of benefaction. So for example, if I provide Australian tax advice, it's called a normal modest fee rate, to the trustees of a non-resident trust estate, then I will have transferred services to that trust estate. What gets me out of the provisions applying is that such a transfer is conducted in the ordinary course of my business, with other transfers having been made by me of a similar nature. So that first exclusion that you can see on the slide in front of you, the 4th bullet point. Acts that cause another to effect a transfer will also result in a deemed transfer having been made by that person causing the transfer. Back-to-back transfers are also caught. So, for example, if I transfer money to Peter and Peter as a non-resident then transfers money to a trust estate, I will still be regarded as a transferor. And to give you some further context of the breadth of these provisions, there's a catch-all, so that if the Commissioner believes anything was done under a scheme to transfer value to a foreign trust, then a taxpayer may also still fall within the definition of a transferor. So as mentioned, the next 3 are generally speaking exclusions. The first one I've touched on, and that's really not going to be relevant to individuals that have an association with the trust more often than not. It'll be more relevant for the kind of example that I just gave you, where a business person is providing, whether it be property or services, to the trust estate. The next 2 exclusions may in fact be more relevant to the situation where an individual is associated with the trust. Now, so long as an arm's length transfer is made, or a transfer is made prior to the IP time, which is 1989, then there may be scope to fall out of these rules. But a central theme to those two exclusions is that the relevant entity that's taken to be the transferor does not and is not in a position to control the trust estate. Control of a trust estate is dealt with comprehensively in the provisions as well, and is yet another defined term. In summary, being in a position to direct the trustee to apply the income or capital of the trust, being an appointor, being able to enjoy the corpus or income of the trust is all enough to result in the transferor being taken to control the trust estate. Similarly, control is looked at on a group basis. So if the transferor's associate acting alone or together with the transferor controls the trust, then so too will the transferor. So, we frequently have to advise clients and remind them that even though the, particular individual of concern may have done something prior to the IP time, transferred prior to the IP time, that individual who may not have set up the trust necessarily is associated with a controller of the trust, let's say that person's father or mother, then they'll be in a position to control the trust estate. And that will be enough to result in the exclusion not applying. Now, in terms of other exclusions, which is over on the next slide, there are three other ways out of the rules. And I often have to remind clients that the ability to rely on these exemptions is very limited. You need to really have a unique set of circumstances applicable to the particular arrangement in order to fall within these exclusions. The first one is about transfers from deceased estates. And what this requires in order to fall within the exemption is that the transfer to a foreign trust is made in accordance with a requirement under the will of the deceased. To the extent that there's any discretion provided to the executor under the will to deal with the property of the trust estate in any way, and that dealing results in a transfer being made to a foreign trust, then the exemption will not apply. The other example, or the other exemption rather, is about transfers from non-resident family trusts. Now, these aren't your standard discretionary family trusts. You've actually got to go again to the section, look at the definition, and realise that what this is limited to is transfers that are made either to a post-marital family trust, which is for the benefit of a spouse or former spouse, and the transferor's children, none of whom are resident in Australia, or a family relief trust, which also has no Australian resident beneficiaries, and of which every beneficiary must be within a family class and identified by name. So again, very rare, and your typical family, your foreign family discretionary trust will not fall within that definition. The final exemption that you can see is what I like to call a pre-migration transfer, so that an individual who, as a non-resident, transferred property or services to a foreign trust estate, if they commence residency in Australia, then so long as they don't control that trust estate after commencement of residency, they won't be taken to be an attributable taxpayer. But what's important to bear in mind is, number one, as I was saying earlier, if that individual has any family members responsible for controlling the trust estate, then they'll likely control the trust estate, and so that exemption won't apply. But the other point to bear in mind is that if the individual does not control the trust estate once they commence residency, but do so at a later point in time, then they'll always be taken to have controlled the trust estate. And so that can be a bit of a sting in the tail. So the second critical ingredient for these rules to apply is that there must be attributable income. You've got an attributable taxpayer, they must be taxed on something, and what they'll be taxed on is that attributable income. The starting point is to calculate the net income of the non-resident trust estate. And net income, again, is defined, and relevantly for discretionary trusts will mean the Section 95 net income in Division 6, which has the residency assumption for the trustee, requiring you to calculate your assessable income less allowable deductions. But the transfer of trust rules do provide for other specific modifications in relation to capital gains, for example, and enabling a deduction for foreign tax to be paid. Further, the amount of the attributable income of a non-resident trust will vary depending on whether it is listed or not. So that if it's a listed country estate, then broadly its only attributable income will be what's called EDCI, or eligible designated concession income, which has not been subject to tax at normal rates in a listed country. So if you take New Zealand as an example, capital gains aren't taxed there, and so would come within the definition of EDCI. So if you had a trust that had capital gains from New Zealand and interest, the capital gain would be included in the attributable income, but the interest would be ignored. On the other hand, if the trust is not a listed country trust estate, then its net income becomes its attributable income. In other words, everything would be included. So all capital gains, all interest, whatever other income may be flowing in, rent and so on and so forth. There's some interesting observations to be made about the definition of listed country trust estates, including the fact that this has nothing to do with the residence of the trustee or the place where the central management and control of the trust estate is located. Instead, the status relies upon the question as to whether all the income derived by the trust estate is either subject to tax or subject to a designated concession in a listed country. And that subject to tax qualification can be in respect of tax paid either by the trustee or the trust beneficiaries. And finally, what you can see at the last point there is a further reduction to the calculation of that attributable income on account of any Australian tax paid. So these rules really operate in a residuary fashion. The CFC rules take priority. The old FIF rules used to take priority, as did the former 96A and 96B deemed present entitlement rules. But to the extent that a beneficiary is being made presently entitled or has been subject to tax under another provision on that income, then the attributable income will be reduced by that amount so that there's no double taxation. Just a few points just quickly to note. Number one, if you've got multiple transferors, it's important to bear in mind that the way the rules work, they actually seek to assess each transferor on 100% of the net income. And the only way out of that is requesting the Commissioner to exercise his discretion to apportion between the transferors the income. And that is done on the basis of working out the value of the property or services that were transferred by each transferor. So if you are dealing with clients and you've got a number of them that have within a family group that have transferred property to the trust, then it's important to bear in mind that there is a real risk of double taxation unless you can properly quantify the value of that transfer and approach the Commissioner and request him to exercise his discretion. The other is that there's a de minimis exception for trust estates in listed countries, but this hasn't been updated since 1991. So in essence, if a listed country trust estate has less than $20,000 of attributable income, the relevant taxpayer is not required to include that in their assessable income. But, I don't know how relevant that is these days. And finally, if there's no information available to determine the attributable income, then there is actually a statutory formula available, but that can result in some pretty adverse consequences based on how it works on a compounding basis. So just to recap and to give you a bit of context to the different requirements, you've got what looks like a relatively complicated diagram, but I'll just break it up into its different sections. So the first question that we need to ask when considering the application of transfer of trust rules is, number one, do we have a foreign trust? So in front of you, you've got a Cayman trust, and we'll assume for these purposes that the central management and control is not in Australia and the corporate trustees are foreign entities. So we have a foreign trust, tick. The other requirement then is that we have an attributable taxpayer. So if you look on your left-hand side, or it could be a right-hand side, I'm not sure if it's showing it differently to you, but there's a transfer by a non-resident at the time of transfer in 2020 of $1 million. So you've ticked that there's a transfer. We'll assume that we've got a discretionary trust. It's not a public unit trust. So is there any exclusion that can apply? Well, because the individual transferred this $1 million at a time that he or she was not a resident, they may be able to rely on the pre-migration exemption. If that person controls the trust estate after commencing residency, then they'll fail the test and they'll be an attributable taxpayer. On your right-hand side, you can see that you've got an Australian resident that transfers $1 million to a Cayman resident, who in turn, under a back-to-back arrangement, transfers $1 million to the Cayman Trust. Again, as I mentioned earlier, back-to-back transfers are caught, And so the Australian resident would be taken to be an attributable taxpayer, assuming all the other requirements are satisfied. And at the bottom, you've got yellow, which is a resident company. This is actually taken from the Commissioner's Taxation Ruling, 2007/13. And it's an example of how broad-reaching the meaning of transfer is and the Commissioner's interpretation of the provisions. What the Commissioner says is that by transferring $1 million to a subsidiary entity of the trust, that is an amount that's being applied for the benefit of the foreign trust, and therefore falls within the definition of transfer, such that the Cayman Trust will be a transfer trust. The implication of that is twofold. Number one, transfer trust rules will apply, again, assuming the other conditions are met. The other is that yellow will be taken to have an indirect 100% attribution interest in Cayman Co. And that will enliven the CFC rules and result in attribution under those rules as well. So something to bear in mind. And finally, in terms of there being attributable income, if we're dealing with an unlisted trust estate, then all of the rent, dividends and capital gains will be included and taxed in the hands of the attributable taxpayer. If it's a listed entity, then we'll have to deal with the modifications and only include what is EDCI. Finally, some key takeaways. The first one is that a transferor, generally speaking, will be taxed on all accumulated income of the trust, regardless of whether it relates to passive or active income. If you're dealing with an individual who's commencing residency, given the broad definition of control of the trust estate, you may want to look at ways of dealing with this before the person arrives in Australia so that the rules aren't attracted. That might result in a winding up of the foreign trust, for example. Any exclusions are very limited and are likely not to apply, so you should proceed on the basis that the rules do apply unless specific circumstances are relevant to your client. The definition of transfer, as you've seen, is very broad, can be by natural persons or entities and direct or indirect. And in fact, entities that are transferors and that are wound up, there are any person or entity that's benefited from that entity that's been wound up would then become a deemed transferor, which is incredibly broad-reaching and draconian in that sense. And finally, what I haven't mentioned that is an important point, if you're trying to address the issue of the individual controlling the trust estate and dealing with a foreign trust, and you're thinking about re-domiciling that trust rather than winding it up, it's important to bear in mind that Division 855 does not enable a transfer of trust that becomes a resident to get a step up in the cost base of its non-TAP assets. So that could result in some pretty adverse tax consequences if the trust does sell those assets down the track, because it will retain a historical cost base. And that's the session on transfer of trusts. Thank you.
All right, thank you very much for that, Jonathan. So we now change gears and turn to section 99B, which is a particularly nasty provision, which I'm sure many of you have the misfortune of having to deal with. So today I'll be providing an overview of section 99B and its companion provision, section 99C. And I'll provide some practical examples of the application of these provisions. What these examples will highlight is the very broad scope of these provisions, and that illustrates the need to exercise caution in approaching foreign trust distributions. So the genesis of section 99B and 99C is the Union Fidelity decision in the 1960s. So in that case, the High Court ruled that section 99 did not operate to make trustees accessible on and liable to tax on income derived from sources outside of Australia. Obviously, Division 6 has moved on a bit since the 60s, and now we obviously have an assumption of residency under section 95. But following that decision, section 99B was introduced alongside its companion, section 99C, and these provisions were introduced to stop Australian residents accumulating income in foreign trusts and then subsequently distributing that amount as untaxed capital in future income years. However, as we will see, it's clear from the broad drafting of these provisions that they cover many circumstances that go far beyond the original integrity concerns to which the provisions were targeted. A question that we're commonly asked is whether Section 99B can in fact apply to an Australian trust, notwithstanding that it's clearly aimed at foreign trusts. The wording of Section 99B itself doesn't provide much assistance and doesn't clearly limit the scope of the provision to foreign trusts. However, it's our view that Section 99B ought not ordinarily apply to a resident trust, and that view is consistent with both the policy behind the provision as well as the comments of Justice Hill and the Track New decision from the 1990s, and a number of private rulings from the Commissioner, I guess for what they're worth, tend to support that position. It's important to note that where Section 99B does apply to a distribution, there's also a deemed interest charge, which could have potentially devastating consequences depending on your ability to sort of trace where that distribution was originally earned by the trust. So if we move on to the next slide, we can look at the framework of Section 99B. So we can see that it's aimed at circumstances where there's an amount which is property of a trust, foreign trust, or arguably a foreign trust estate, and that is paid to or applied to the benefit of the beneficiary, being an Australian resident. So there's two potential limbs that you may have to consider. The first is relatively straightforward, that there's been a direct payment. The second is a little bit more nuanced, and that's where you have an amount that's applied for the benefit of the beneficiary, and we'll move on to Section 99C shortly, which provides a bit more colour to that. Some examples where you might have Section 99B applying would be just very simply a transfer of just a cash distribution from a foreign trust to an Australian beneficiary, so that's relatively straightforward. There are a number of exclusions to Section 99B, which is set out in 99B subsection 2. The most relevant or the most commonly used one is the corpus exception. So where an amount's drawn from corpus, as you'd expect, it shouldn't be subject to tax under 99B, but there is an exception to the exception, and that is that where that amount is distributed is derived by the trust, and if it had been a resident at the time it derived that amount, would have been included in the assessable income of the trust. So an example of where that might apply, that exception might apply, can be seen in the Howard decision, which we'll get to shortly. But firstly, it's just important to note that, as with all tax cases, the onus of proof is on the taxpayer to prove their position, and where you are claiming that an amount is corpus, you need to be able to back that up. An example where the taxpayer fell short of satisfying that requirement was the Campbell decision from last year. So that involved a New Zealand trust which distributed around $33 million to an Australian resident. The accountant in the AET sought to claim that amount was from the original corpus of the trust and therefore should be covered by the exception. However, the accountant in that case didn't really do themselves too many favours, because there was originally accounts prepared which showed a large amount of accumulated income from which that distribution was drawn. But then at the AET, there were revised accounts which showed a large amount of corpus instead. So there was no there's no clear explanation as to why that was why the accounts were revised. And unsurprisingly, the AET was not convinced, and the taxpayer was unable to prove their distribution was from corpus. There's a couple of other sort of examples there. The main one is where you have amounts that are otherwise assessed, for example, under Division 6. So if there's a present entitlement to income, that won't also be subject to 99B. So if we move on to the example based on Howard, this is quite simplified. But if we start at the top, we can see that there's an amount that's originally settled of $100 on the Mars Trust. That $100 is then used to subscribe for shares in Mars Limited. Sometime later, there's a share buyback for $150. So if my maths is correct, we have a $50 gain in that circumstance from the transaction. That amount's then sensibly paid to the alien trust as a distribution of capital and then ultimately paid out to an Australian resident. So if we cast our minds back to the corpus exception, we can see that ostensibly we have an amount of corpus coming out. However, it's an amount which, at least in relation to the $50, is an amount that would have been assessable had it been received by an Australian resident. So unfortunately, in that circumstance, Section 99B would apply to that amount and the tax of the Australian beneficiary would be assessable. So we'll now move on to circumstances where amounts might be considered to be applied for the benefit of the beneficiary. So Section 99C casts a wide net and covers all benefits that may have accrued to the beneficiary, irrespective of the nature of the form of those benefits. And then subsection 2 provides for a number of circumstances where you might be considered to have an amount applied to the benefit, which might come as a surprise to many. So the first example would be where you have the trust reinvesting or accumulating or capitalising amounts or otherwise for the benefit of a beneficiary. But more interestingly, the provision will also cover not only the making of loans to a beneficiary, but the repayment of loans. And that might come as a surprise to many advisors, because you would generally expect to not have a loan being treated as a distribution effectively. However, that's just an example of the broad scope of the provisions. And unlike the transfer of trust provision, there's no sort of market value or arm's length type exception. There's a loan, then prima facie you need to consider whether 99B applies and whether any of the exceptions may apply. Importantly, there is a lot of indirect and directly type wording in these examples. So if you've got amounts that you can sort of reasonably trace through, then through an interposed entity or similar, then the provisions are broad enough to capture that. The Commissioner takes the view that 99C will be satisfied so long as the relation between the benefit and the trust property is not so remote as to be insignificant. So only a casual or other connection is required to have in regard to the purposes of Section 99C. So an example of 99C in operation is on the following slide. So this example, if we just start at the top, involves a foreign company which has paid dividends, $1 million to a foreign trust. The trust has then used that money to make a loan back to the company. And then step 3 is that the company has then lent that money. So this has been an example of a loan to an Australian trust. So the way that you get there under 99B in this scenario is that you have an amount that's applied for the benefit, albeit indirectly, via a loan to an Australian resident. And Section 99B should be activated in that circumstance. It need not be companies, though, or trusts that you're interposing. A common example where you may get tripped up is where an Australian resident receives a gift or a loan from a relative overseas, and that relative's got that money from a trust distribution from a foreign trust. So when you're receiving money from overseas, you just need to be mindful that you may need to inquire as to where that money came from originally. So that concludes my part of the presentation, and I'll now hand you back over to Paul to mediate the Q&A session.
Thank you very much, Peter. We have had a number of questions, and perhaps we'll start with Section 99B. The first question is, in the example that was provided in the earlier slide, not the most recent one that you're looking at, Peter, does a Section 99B apply to the $150 distribution or the $50? Perhaps sorry, Peter, go ahead.
Thanks, Paul, and thanks for the person who asked the question. It'd be the $50. So provided that you could, substantiate the $100 of original corpus coming in, you could identify that, then that should come out under the corpus exception. But the $50 is an amount of a gain that would have been assessable had it been received by a resident.
And really, the critical proviso there that Peter adverted to was evidence. And if the cases teach us nothing else, and there's not all that many on 99B, but if they teach us anything, that evidence and contemporaneous documentary evidence about the establishment of these trusts and the corpus that they started off with and what they've derived over their history become absolutely critical when one looks at any circumstance where there's a possible application of these provisions. These provisions deal with, or don't deal well with, if one looks at it from a taxpayer's point of view, entities or structures that are set up without proper documentation. The taxpayers will always have the strict onus of proof, and that becomes a critical aspect in most disputes concerning, or inquiries at least concerning, these particular provisions. Another question we have, and that is the interaction with section 99B, and in particular the circumstances where 99C adds to what is in fact the distribution, and its interaction with division 7A. Peter.
So the example, which I assume this is based on, would be the last example. So division 7A could apply to a non-resident company. However, it would only apply in respect to a shareholder or a shareholder's associate. So I guess you would have to analyse whether or not the provision should be activated, because you would need to have an amount going from a foreign company to a foreign trust. I know in the example the money comes directly from the foreign company. Yeah, so division 7A could apply in that circumstance, and it would just depend if the Australian trust was an associate of a shareholder, which may well be the case in this scenario, so that could also be an issue.
Indeed, in principle, there'll be similar issues with section 47A in the context of benefits provided, by a CFC in that example, and with the sort of underlying principle that these provisions, in a sense, are residual just because of the exceptions that are provided for in subsection 2. To the extent that any of those exceptions apply, one sort of would see these provisions engaging in that way. Another question that we have, and perhaps Jonathan, we could ask you this, that's come through. Are we seeing more foreign trusts being viewed by the ATO as Australian residents trusts post-Bywater, and the Commissioner's rulings and deliberations on the question of corporate residency and trustee residency?
Sure. Look, I mean, it's obviously a hot topic post-Bywater, and the view in the market that the term central management and control and carrying on a business has been conflated and basically simplified into one test. And so obviously, either in a corporate residency context or even in a trust context, one needs to turn their mind to, who in fact is controlling the trust estate, and whether the interpretation around residency in the context of corporates can be applied equally for a trust estate. So, if an individual is taken to control the trust estate, which could attract the transfer of trust rules, as a precursor to that, you'll also want to make sure that you're confirming whether in fact that trust estate is carrying on business and may in fact be a resident trust estate rather than a foreign trust. Certainly the kinds of questions that we see come through from the ATO do consider those issues, and we need to address them. Am I seeing more foreign trusts being viewed by the ATO as Australian residents? I think the question's always been asked. I don't think I've seen necessarily in my personal experience a spike, but it is something that you always need to turn your mind to, given the revised rulings that have been issued by the Commissioner.
Thank you, Jonathan. Just another question that's come through. The framework of the transfer trust rules deals with trusts. There's no particular definition other than through some of the mechanics of how the rules work about what trusts are. We would understand in our common law jurisdictions what a trust is, but can the transfer trust rules apply to civil law entities, such as Stiftings and Stiftungs? Are they potentially, can they be defined or fall within the scope of trust for the purposes of these rules?
It's a good question. Certainly the answer is yes. One will need to have regard to the particular characteristics of the relevant entity and determine whether what they're dealing with has characteristics that are akin to a common law trust. So you'd be looking at things such as, are the assets constituting a separate fund? The title to the assets stand in the name of a trustee for the benefit of others? All the sorts of key elements that you'd be considering in a common law context about what a trust is. Likewise, I mean, if you're dealing with foreign entities that have legal personality and you've got limited liability, for example, then it may not fall within the definition of a trust, but may instead be a company, and then you've got to deal with the CFC rules. There's certainly, from having looked at various ATOIs and private rulings over the years, and in our dealings with the ATO as well directly, in terms of voluntary disclosures and how we've sought to treat particular entities, the Swiss and Panamanian type foundations and the Liechtenstein Stiftungs that Paul was referring to would normally be regarded as a trust from the ATO's perspective. And then you might have things like the Anstalts that will instead be a company. And so you've got to make sure you're paying close regard to the constituent documents that is relevant to the entity, forming a proper view about how that entity should be characterised from an Australian tax law approach, and then applying the rules accordingly.
Thanks, Jonathan. And the difficulty in characterising these foreign type of entities into the particular concepts, the statutory concepts we have, is not, unique to these provisions. We've had to deal with it, in treaties, in the CFC rules and various other things too. But as you say, Jonathan, the way in which the Commissioner tends to look at these things is to sort of have a list of features of what a trust is. It's a relationship over property where you have a trustee who holds property for the benefit of beneficiaries. So to the extent you have features of these foreign entities that coincide with those basic features, well then the Commission will regard it or not regard it as a trust for the purpose of these rules, and for that matter for Section 99B as well. Perhaps just one final question before we break, which has come through. Peter, with 99B and the application of the interest charge under Section 102 AAM of the Act, how was the interest actually calculated for that purpose?
Thanks, Paul. So to the extent that you've got a distribution that's been received by an Australian resident beneficiary who is assessed under 99B, under 102 AAM, there's an automatic interest charge. So an example of how that might work is that just taking a step back, the intention of the interest charge is to kind of make up for the time that you've had the amount essentially being accumulated tax-free overseas. So it seeks to apply an interest charge, which is set at the base rate, going back to, and it's a first in, first out sort of principle. So you need to potentially go back to when that income amount that initially came into the trust, you need to work out when that came in and apply the interest from that point forward. So it could potentially have quite devastating consequences, particularly where your records are problematic, and you may in fact have to go back to 1990, which interest rate's quite low at the moment, but the base rate in the early 90s was much higher. So you could have that compounding over a number of years, which could be, could even outweigh the actual distribution amount, and then you have an amount that you have to self-assess that could be quite large.
Thanks, Peter. And does the Commissioner have the power, the discretionary power, either in the 36 Act or under the Tax Administration Act, to remit that interest charge?
The interest charge under 102 AAM is not actually akin to GRC or SIC. It's just an additional charge that it just applies where you have Section 99B applying. So there's no discretion in the provision itself to provide for any remission. Which,
and again,
you know,
as you say, it's a self-assessed provision. Just a final question that we have from one of our guests, and the question is this: are you able to distribute corpus and leave behind accumulated income? A question we get asked quite often, actually. And if so, what documentation would be required to support this? Would trust resolutions be sufficient? What records would you ordinarily want to have to discharge the onus of proof?
So thanks for that question. 99B is clearly quite a popular provision today. So I guess the starting point for that question would be to go and read Campbell and learn the lessons from that case. But I guess what it boils down to is making sure that you have contemporaneous evidence, basically from the start of that trust, supporting the original amount of corpus that came in. And then you can sort of trace that through, and you've got accounts that are not sort of mixing up corpus amounts and accumulated income, as they often do, particularly in jurisdictions which may have a different accounting standards to that in Australia. So the documentation, of course, you would need to have resolutions, but if you had amounts that would clearly come into the trust in the nature of income, and then were then immediately flowing out, that might be a concern. So you'd want to just make sure that you're doing your accounting entries correctly, and that's sort of preferably supported by resolutions where that's been acknowledged.
So in principle, our view is that one can distribute original corpus as opposed to accumulated income. So one does not have to assume that there's some sort of proportionality in a distribution coming out. The trustee can resolve to distribute corpus as it came to the trust in the original form. That ought not then be subject to 99B because it falls within the exception in subsection 2. Look, unfortunately, our time is now gone, and we have to bring this to an end, unfortunately. Again, if there are any further questions or things that people want to talk about, please reach out to us. More than happy to have a chat to you about these provisions. But look, it's just now for me to thank Jonathan and Peter. A quick but valuable survey of these provisions. As Jonathan mentioned, we deal with these provisions, engage with the ATO on these provisions frequently for incoming taxpayers becoming residents, for deceased estates and historical structures that might have been established overseas without the knowledge of Australian residents. And that's important to understand, that you can be caught by these provisions at having no knowledge about the establishment or foundation of these structures overseas, trust structures in particular. So Jonathan and Peter make clear that there are perils in the shadows with these provisions, and amounts of money received from offshore will always be a flag, or one can assume there'll always be a flag for consideration of these provisions. We may rule them out, but that's something that will always have to be considered. These are broad inclusionary rules with prescribed, and in the case of the transfer trust rules, very limited exclusions. And within those exclusions, there are exclusions. So exclusions to the exclusions. There are inbuilt integrity rules within these integrity rules. To be honest, it's exhausting just even thinking about it. But these rules do require, and this is the peril, they don't require a determination by the Commissioner. You have to self-assess these provisions and determine how they work if they apply to your particular circumstances. So that's it on that topic. We have in the pipeline a further 2 tax webinars. The next one next week is on Section 100A. That'll be presented by Caitlin Loudon from our tax team and myself. Again, Section 100A is one of the capital A's that was introduced in 1979. And then following that, the week after, we have an update on FIRB topical issues and New South Wales and Victorian state taxes. Again, thank you all very much for attending this ABL webinar. Stay well, stay healthy, and we hope you'll all join us again for the next one. Thank you very much.
Thanks, everyone.
Thanks, everyone.